It's 2005 and Takeshi Kotegawa is at home, scouring the markets and looking for a good setup to enter into a trade. Suddenly, he notices an opportunity. Mizuho Securities were selling 610,000 shares at 1 yen each, equivalent to about 1 cent per share. Takeshi doesn't hesitate and manages to buy 7,100 shares. Shortly after that, he sells a portion of the position after the price bounced back. The other shares were held overnight, eventually making him $17 million. So what caused this? And how did Takeshi manage to buy the shares at such a low price? Well, Mizuho Securities actually meant to sell one share at 610,000 yen each. A trader that worked for Mizuho Securities accidentally switched these two numbers, causing for a severely discounted price. One could argue that this was simply luck and that Takeshi was just lucky that he had noticed the error. However, this argument is quickly made invalid by the fact that even before the error arose, Takeshi was already a skilled trader. He later proved this by continuing to trade, eventually surpassing a milestone of over $150 million. So who is Takeshi? What was the exact strategy that he used? And is it possible for anyone to use his strategy? All of these questions will be answered in this video. Before we take a look at the strategy he used, it's important to understand who Takeshi is and his approach to trading. Born on March 5, 1978, in Ichikawa, Chiba, Japan, Takeshi started trading stocks on the Tokyo Stock Exchange in the bear market of 2001. He started out with around $15,000 and over time this balance grew to over $150 million. Despite being a multimillionaire, Takeshi has remained humble, never buying expensive fashion items or flashy cars. He has a few lessons that he has shared before. It's important to understand these lessons because they are the foundation for making profit from trading. The first lesson is that mindset is one of the most important aspects of trading. Chasing losses or adding to losing positions are some of the most common ways that traders lose money and eventually give up on trading. This is why whenever Takeshi trades, he is very focused and does not allow for any distractions. His stock list consists of over 600 stocks, and he has 30 to 70 positions open at a time. Constantly monitoring these positions requires a lot of concentration, since closing or opening positions at the wrong time can cause for extreme losses. Interestingly, Takeshi also uses the performance of his positions to get a feel of the current market sentiment, causing him to have a better idea of where prices might be headed. The second lesson is to not focus on the results. Takeshi has stated in an interview that if you care too much about money, that it won't be possible for you to become a successful trader. According to Takeshi, it should feel better to lose $10,000 than to profit $50,000 if the losing trade was a good trade and the winning trade was a bad trade. From this, we can conclude that sticking to a strategy and the rules is crucial to be able to profit from trading. So let's now take a look at the strategy that Takeshi uses. Let's first take a look at the basics of his strategy. Simply said, the strategy he uses consists of finding stocks that are in a long-term downtrend and buying them at the right time, when the price reverses its direction and starts going in an upwards direction. Of course, knowing the bottom or reversal point of a stock is very hard. So to understand how and when he takes trades, let's take a deeper look at his strategy. You might think that his strategy includes a lot of fundamental analysis, which would mean that he looks at the fundamentals of a company and decides if the company is undervalued based on its fundamentals. But Takeshi actually usually only uses technical analysis. He first looks at the top movers of the current or previous day and adds these stocks to his watch list, looking at the price action on the 5-minute time frame. Then he would use momentum indicators like the MACD to determine when the stock would start moving again. He typically holds a stock for 2 to 6 days, but sometimes he held stocks for over a week, depending on the changes that the market has made. Takeshi also finds bear markets easier to trade because there are more opportunities that present themselves. In a forum post on the now-closed Japanese website 2 channel, he made multiple posts detailing one of his strategies. One of these posts stated the following: whenever going for a short-term rebound, what you should be focusing on is the moving average divergence. Naturally, the greater the degree of the divergence, the greater the odds of the stock going back up. He also provides an example of this, saying the following: in the bear market of 2001 and 2002, I would only look at stocks at least 20% below the 25-day moving average, 35% being a somewhat safe level to buy at. The price would then surge, at which point I'd close the position at a profit. At this stage, the divergence would narrow, from say 35% to 15%, but after a while, the price would once again fall 30% below the moving average, restarting the cycle. However, after stating this, he would also go on to say that in the following year there weren't many opportunities where there was such a high divergence from the moving average, adding that it was common to see stocks make a rebound at a divergence of just 15% from the moving average. This was also dependent on the sector, since some stocks were more prone to have larger divergences than others, explaining that you will first need to develop a feel for each sector's general dynamics. Now let's head over to TradingView and look at some examples on the charts so that you can fully understand his strategy and trading style. But before that, if you are looking for a broker that has extremely low commissions and spreads, then check out Trade, the best broker to trade forex, indices, commodities, or crypto. They have live chat support so that any questions you may have can be quickly and easily answered. One of Trade's most prominent promotional offers is the matching deposit bonus that can be claimed when you open an account with Trade. Sign up via the link in the description to register with Trade and get access to all of these perks. Let's first add the indicators to the chart. The first indicator we will be adding is the moving average indicator. In the posts and interviews, Takeshi doesn't specify if he uses an exponential moving average or a simple moving average, so we will be adding a simple moving average since this is the most straightforward indicator. So head over to the Indicator Search tab and search for the moving average indicator. Select the indicator made by TradingView and add it to the chart. The second indicator that we will be adding to the chart is the MACD indicator. Search for the MACD indicator and select the indicator made by TradingView. Now let's change the indicators to replicate Takeshi's trading style. First, head over to the moving average indicator settings and change the length to 25. Next, we will be changing the color of the line to make it more visible. Now let's change the MACD indicator settings. Click on the MACD indicator settings and navigate to the Style tab. We will be unchecking the MACD and signal line. That was all that we needed to do. Now let's take a look at an entry that can be made with the strategy. We are currently looking at the SoftBank price on the daily chart. We see that the overall trend of the market is currently bearish. Keeping this in mind, we will switch to the 5 or 15-minute timeframe based on the sector. For the showcase, we will use the 15-minute timeframe. On the 15-minute chart, we can see that there was a very large divergence between the price and moving average. If we look at more recent price action, we see that the price has started trending to the upside. Takeshi also uses basic support and resistance lines, so let's draw these support points on the chart to make them clear. As you can see, we can see that the price has clearly started trending in the upwards direction. Finally, if we look at the MACD indicator, we see that the histogram is also clearly indicating a trend reversal. Based on these signals, we will enter into the position. It's not clear what the exact strategy is for placing the stop loss that Takeshi uses, so let's place the stop loss at the recent swing low. Takeshi usually doesn't use a predetermined take profit. He will exit the position based on what the chart says and the current market conditions. So let's observe and exit based on the market conditions. We see here that after the massive increase in price, the MACD histogram has turned red. We also see that whenever the histogram turns positive, the value is very low. In addition to this, about 4 days have passed, and since Takeshi usually stays in a trade for about 3 days, this also indicates that it may be a good time to exit. So let's put our take profit here and exit the position. Now let's take a look at how the price reacts after the exit. Takeshi follows the philosophy of keeping a chart simple. Instead of doing extremely complicated analysis, it's better to spot simple buy patterns and trade based on those. Let's take a look at an example of this. As you can see on this chart, we can clearly see that the price is bullish, making higher highs and lower lows, which makes it easier for us to determine when to enter into a position. Remember that the strategies shown are based on what Takeshi describes in his posts and interviews. Please always test a strategy before using it in live markets. I hope you enjoyed and learned something new from the video. If you did, please leave a like and subscribe to the channel so that we can keep creating these free videos.